Hello, everyone, and welcome to this week's podcast from February the 28th, 2022. It's the last day of February. In some cases, many may be excited about that because it has been a tough month. And that is maybe the easiest and most apt description that we can give you as far as how the month of February has gone for the market, not only domestically, but internationally as well. And that's a lot of what we're going to talk about today. We're going to take a first look at some of these indicators, some indexes, where those support levels now sit, then take a look at how the indicators have been impacted, and then really touch on some of the commodity space and how geopolitical tensions have caused rises in certain commodities and really continued to show improvement and really breadth of improvement in a lot of ways within the commodity space. But to dive right in, first and foremost, we obviously have seen, generally speaking, U.S. equities move lower during the month of February and even move lower last week after especially the news that Russia was invading Ukraine. And that really sparked a pretty big sell-off and really sparked a notable movement within stocks in many cases on the domestic and international equity front. And taking a look at something like the 25 point per box chart of the S&P 500, we saw it take out its trend line on that 25 point per box chart and move down to 41.25 with action last week before reversing right back into X's on Friday up to 43.75 on that particular chart. But the move lower took out some pretty key levels of support. Again, on that 25 point per box chart, we saw the trend line violated. We saw support at 4,300 and 42.25 violated, as well as even support looking back to June of last year violated. And at this point, support for the S&P 500, at least on that 25 point per box chart, sits there at the 4,075 level. And below that, we're looking to levels we haven't seen since March of last year. So pretty significant breakdowns that we've seen in a lot of the indexes. We could go on through many of these U.S. equity indexes, and it would be a fairly similar theme. Support levels violated and things like that, as we saw a pretty significant move lower. But again, we saw a reversal back into X's on Friday's action, have seen a little bit of downside as well this and Monday on this day. But that has in turn caused quite a bit of action to occur on the indicators. And really that's where Will and I will probably spend most of our time, is talking about these indicators, what to look for, and really where we need to see confirmation. And that's going to be the big theme, is looking for confirmation.
Yeah. I mean, we've been getting a lot of questions about, is this the place to step in? Is this the level that we're going to see demand from? And we don't know for sure, of course, but we can at least get some evidence together to make us better prepared to do that. And honestly, I was going to mention to the listeners as well that, David, when you and I were trying to start the podcast, we're like, well, where do we even start this week? Because we didn't have one last week on the holiday. And I'm like, where do we start? And David, I think you're like, well, maybe we just start with that comment of where do you even start? Because I know we've been looking at like futures over the weekend, and you've been seeing some insane swings in the futures market. I know you're down like 3%. You end up opening like 1% down, and then maybe you're up 2% on the day. So just some really wild moves right now, some very extreme events that it's calling the type of sentences that are like, well, this hasn't happened since 2008 or 2018 or 2020 in a lot of instances. So pretty crazy scenario. And then I would say as well that this is an interesting time to be using point and figure charting. So the charts that David was mentioning, these are point and figure charts. So they're using intraday highs and lows. So keep that in mind if we open, 3% down on the day, that means we have an intraday low of somewhere 3% down. But if we end up closing 1% higher on the day, that chart action is kind of changing on a different basis than you would expect. So maybe you're getting some column changes later because we got to go one direction per day on point and figure charts. I'm not going to go into all the rules of that. It's not what's important today, but it's just a very interesting time for the jargon and those that are up to speed on these charts. You're probably seeing some pretty funky things right now, but it's also really helpful because it's really noisy and they're creating some pretty good levels of support, I would argue, at least.
Oh, for sure. I mean, especially, like we talked about with the S&P, and you could, again, apply this to the old cover up the name of any chart. You could apply this to almost any chart at this point in time, whether it be a long, short term, whatever it may be. you've just seen some breakdowns and support levels violated, and in a lot of cases that's led to, like we said, we talked about earlier, this change in these indicators that maybe isn't as much of a change as one might think, because we've seen the indicators generally moving lower starting 2022. But I mean, starting off the week last week, we saw the bullish percent for the optionable universe reverse down. And then the very next day, the BP for the NYSE reversed down. And ultimately, with action through Thursday, it fell down to 36%, one box above where it hit that low mark at 34% in January. But that, in truth, has been a common theme across pretty much all the indicators. We saw a reversal back into X's as stocks returned to buy signals, those first 2 weeks of February, and then it reversed right back down, especially with much of the action last week that we saw. And, the bullish percents aren't the only one that we saw a lot of action on either.
Oh, yeah. We've seen a ton of action on the short-term indicators, and it's probably worth mentioning as well. I'm sure many are aware listening to this that the geopolitical uptick that's really catalyzed a lot of this recent movement. It's not like we were just cruising at all-time highs before that. The market was already trying to price in some rate hikes, a pretty hawkish Federal Reserve, some commodity pressure, supply chain issues, lingering COVID uncertainty. So the market already had a fair amount of uncertainty coming into this instance. So this
was the cherry on top of the sundae.
Cherry on top. It was the, what is it, straw on the camel's back or something like that. But
straw
it was
just camel's back.
That. So just a lot of just tacking on capitulation indicator movement that we've seen. Nonetheless, we're looking at price at the end of the day. We're not economists. We're not politicians. We're not fundamentalists. We're looking at price now. That's affecting some of these indicators. And like we're getting at, some of the short-term indicators have reached pretty extreme levels and even some extreme moves over the past couple of weeks. David mentioned the bullish percents. So the percentage of stocks trading on buy signals, that's approached washed out territory in some instances, as he said, kind of around that 30% level is where we're going to see historically kind of buyers step in around that time or below that time has served as a good opportunity upon signs of demand, which we'll touch on in a bit. Some other ones that I'll mention are the 10-week indicator. So if you're familiar with those, the percentage of stocks trading above their 50-day moving average, that has done a couple double dips down in low territory. It's a pretty sensitive indicator. So we've seen that chop back and forth, but it's still in low field position across the indexes right now. So looking for some reversals up there, I think could be a pretty constructive picture technically. If I had to mention a couple indicators, and then I'll kick it back to you here, David, the bullish percent for the NDX, that's down at 24%, chart level of 24%. 10-week just reversed up back into X's on Friday. In fact, a ton of 10 weeks reverse back up into X's on Friday. The S&P 10-week, the NASDAQ 100 10-week, the S&P Midcap 400 10-week indicator, New York Stock Exchange, the list goes on. So a ton of that movement you saw on Friday. I'm looking for some confirmation. You do get the double dips, but some signs that maybe we're trying to find some demand here.
Well, and a lot of it is we've touched on when we began was we're looking for confirmation. Confirmation is the key here. And I mean, whether it's a short-term indicator like the 10-week or even the high lows, the NYSE, OTC, and some of the other high lows, we've seen them revisit low levels, which isn't uncommon. In many cases, it's actually more common to see it visit lower levels again before ultimately resuming higher. So not surprising to see this. In some ways, we actually like to see these indicators on the second trip making a higher bottom, and you'll hear us refer to that on a lot of charts. Doesn't always happen that way, but it's something that it at least gives us a better idea that okay, maybe we're in this bottoming process. And that's sort of what we're viewing a lot of this. But again, confirmation is our key. And that's what we want to see when these indicators begin to move back, into a column of X's and increase their values again. Is that confirmation that we're moving above 30%, and from there that the indices are also moving back to buy signals, getting back to where we saw levels that we began the year, things like that to give us an idea that okay, demand is coming back, and that's when we can really begin to make our probably more our asset allocation choices, if you
Mm-hmm.
will, in terms of putting money back to work. Because I feel like we've gotten a lot of questions about people looking at particular stocks
Mm-hmm.
or areas of the market, and there has been some opportunity, but that has been few and far between compared to
Yeah.
many kind of the asset allocation pieces. So
Yeah.
confirmation is going to be the name, and you're going to hear us talk about that a lot in this video, on other videos, in the
Yeah.
reports, and you're probably going to get tired of us saying it, but it's really what we're looking for, because
Yeah.
until that happens, you're honestly doing a fool's errand of
Yeah.
trying to time when this is going to bottom and when this is going to turn around. And that, as we've looked at many times before, trying to be the perfect timer has it historically not worked out as well as one might think.
Yeah.
So you'll
Yeah, I
hear
mean,
us say it a lot.
I'll definitely hop in on that and reiterate that our indicators are trend following strategy. So we're not looking to pick bottoms or pick tops here. So looking for talk about confirmation, a reversal up on the high lows is certainly one. A reversal up on the bullish percent charts would be another layer of confirmation. On the index charts, as David mentioned, some higher bottoms. So those reversals to O's and then going back up into X's would be another layer of confirmation. All of those, I think, could be used as some near-term signs that we're seeing some demand and maybe kind of start walking back in. But until that happens, we're not going to try to catch a falling knife in this scenario. And we like to mention this as well, that we like to view our indicators, or at least this has been described to me, David, as they can be used as a roadmap, but in the sense of telling us where we are currently in a given market environment, not necessarily where we're going. It's not about forecasting it, saying, well, where are we right now? And based off where we are right now, what type of risk levels do we typically see in the market? And what's a strategy from here going forward? And then I'll just toss one more comment on this as well. We've talked a lot about those near-term indicators looking like they're trying to find a bottom here. On the long-term front, we haven't seen a ton of changes. So the biggest change we've seen is that commodities have really been just stronger than your equity markets pretty much across the board. A lot of that attributed to oil and energy, maybe
And
kind of
that is
related to the geopolitical.
confirmed that it's occurring.
That has been confirmed on the
Yep.
longer term stuff. Yeah. So that's been in motion for a couple months now, if not more than that. So commodities kind of have that reign of leadership for the long term. But even with commodities and leadership and equities kind of trailing near that, it's still a broadly risk on posture for your long term indicators, because we're not seeing cash materially overtake risk exposure. You're not seeing it from fixed income, that's for sure. So your risk assets are still functioning better than your defensive assets, we would say, from your longer term. Right now, the question is more so, when are you putting that residual cash to work, or where are you adding risk exposure? That's when we're looking to the near term stuff. So wanted to mention that, at least kind of put a note on that on our report Friday as well.
Well, and like we were talking about in terms of where do we look right now, it still gives you very much this risk on sentiment. And, we mentioned that the one place that we are getting confirmation is out of the commodity space. And the commodity space saw quite the impact, as obviously whenever we touched on earlier, Russia invading Ukraine, one of Russia's, if not the biggest import, is oil and natural gas. And because of that, we have seen crude move above 100 for the first time since 2014. And that, obviously is hitting us in our pockets at the gas station. But for those who have been in crude for quite some time, it's a positive that we're seeing that leadership from crude, ignoring the external factors, that leadership's still there. And not only are we seeing leadership out of that energy space, but you're seeing still a breadth of strength out of commodities in general. Because even if you look within base metals right now, and that, looking
agriculture,
on
it's been great.
Right. Exactly. Yep. And here recently, at least as recent as last week, we saw gold spike clear a couple levels of resistance, and now it's retracted quite a bit following Friday's action. But you've seen that precious metals group join the fray of the breadth and improvement out of commodities. So right now, it's almost a way that you could look at, beginning of the year, it was, okay, I just want to get my broad-based commodities exposure to be sure I've got it. Now you can almost look at it as there's improvement and there's this
Yeah.
breadth of improvement. So we can get a little more specific, but it also allows you in a way to kind of quasi diversify within commodities by looking at these other areas of the commodity space. And there's really, I mean, again, the precious metals is somewhat the laggard, if you will, but like we talked about, looking at industrial, looking at agriculture, a lot of those things pulled back into actionable territory after last week's action and are looking like potential opportunities that you could step in right now.
Yeah. I mean, there's a lot of, I think, kind of ripping the Band-Aid off scenario right now. And this is pre the geopolitical event, but you're seeing asset classes actually give you diversification benefits now where you're probably going to be getting some more yield and fixed income. At the end of the day, that's probably a positive in the long run. You're getting returns from commodities. Equities are struggling right now, of course, but maybe those start to find a bottom as well, that you're actually not necessarily foregoing return when you're going to other asset classes, but you're getting yield from fixed income, or will hopefully be getting yield from fixed income should the trend continue. Commodities are doing well, et cetera. So the long run, maybe that's a positive for portfolio diversification, at least. And then hopping over, kind of jumping ships here from the asset allocation kind of risk metrics, but quasi-related, I would still argue. David, you mentioned sentiment, and that just keyed me off because I was looking at some of these numbers last week, and I get some emails from other kind of market strategists and commentators, and everyone's talking about sentiment right now. You have, I would say, overly bearish sentiment right now, at least relative to the bulls. Whether
it's definitely not sunshine and rainbows out there for
no. Yeah, I mean, tough to spend. If you're looking at like the AAII, the Association of Individual Investors, you're looking at just the II numbers. I mean, whichever way you look at it, it's pretty tough to spin it where we're sitting at pretty extreme levels of bearish sentiment. Typically, that's a contrarian indicator to kind of beware of the crowd. That's something else that we do track on the system. So we have that under the economic indicator charts. I like to mention these. We had this featured in our Thursday report, but that bullish sentiment is also at multi-year lows. So maybe a reversal up from there, maybe tack that on to a near-term indicator as well.
Yeah, and it's obviously with many of these things, sentiment plays a big factor into how we're trying to make a decision, and that is, many who listen to this podcast will hear us talk about that is in big way why we're believers in this objective rules-based process. Because and right now is by no means the time to, if you haven't already done it, right now is by no means the time to be starting to look at doing it. That is our one piece of advice. You want to get these rules-based objective approaches down pat when things are good, so then when things turn bad, you've got that to fall back on. And that's hugely and immensely important to understand that right now is not the time to be looking to change up how you've been doing things. It may be tough. It's looking like we're watching portfolio values fall. It's always uncomfortable, but it isn't the time to be saying, oh, well, now I'm going to look at this indicator reversing down against cash or things like that as going to be my trigger. That's something that, feel free to call us. We'll do that and have that conversation when the market's moving higher, not when it's moving lower. But even then, I mean, looking at the sentiment just across different asset classes, we did touch on one thing that, generally speaking, there's pretty positive bullish sentiment for the dollar, though. I mean, that's looking at that particular chart right now. The DEX / it's going to be the NYC US dollar spot index. It's recently gave a fifth consecutive buy signal by moving above 97.50, reaching levels we haven't seen since June of 2020. So seeing the dollar strengthening there, and it is somewhat confusing to have this conversation about US dollar strengthening, but our number one asset class is commodities. Because historically speaking, commodities tend to be weaker in a rising dollar environment. But at the moment, that's our number one asset class. That's where we're seeing the leadership from, and we're also seeing improvement out of that dollar. So to say there are some cross currents of uncertainty, we touched on that earlier, but they continue to be prevalent. And that's why, and pretty much everything you've heard us refer to today, confirmation. Confirmation is what we want to find when looking at indicators. Confirmation is what we want to find when we're looking at positions and trends. We want to see stocks returning to buy signals. We want to see resumptions of positive trends. We want to see things moving higher. And yes, we're going to miss that turn. Being trend followers, it's what we do. We want to catch the bulk of a trend. We'll never get out at the top, and we'll never be right back in at the bottom. But it is something that, being trend followers, we want to catch the bulk of that trend. We want to catch it. And that's what our research has shown has been the benefit. And catching that trend is much more important than trying to sit here and figure out exactly when to jump back in. So we can look at our buddies and say, you know what? I got in at the bottom. You get one brag at the bar about that, and then that's about the only positive you'll get from it.
Yeah. I mean, the trend following component, it'll keep you in things longer than you would ever expect and feel comfortable with, and it'll keep you out of things longer than you would expect and or be comfortable with. So that's the benefit of it. Like David said, objectivity is, of course, also one. And then something else I would say, kind of when you're like building these plans, I was thinking about, building portfolios. You're never really building a portfolio for your average market environment. It's for these extreme events that you have the rules, that you have the game plan in place. And even looking at the market returns itself, if you actually find a year that the market returns the average, good luck. I mean, you're typically up 20 or down 10 or something like that. So you're building these portfolio strategies to not necessarily behave on the average, but to be able to take advantage of your big moves in the market, either up and down. So that's something to keep in mind too. So I don't want to drag on too long here, David. I think we could go through a lot of things, but I think at least the message has been clear. Our kind of summary on kind of what's going on over the past couple of weeks, strengths, kind of long-term trends still in place, pretty much all covered here. So if you don't have any final thoughts, I do have one announcement, and then we can part ways.
Nope, go right ahead.
All right. Yeah. The one announcement I'll say for those that are familiar with us, or if you've been with us a while, or even if you haven't been with us a while. So pretty much everybody listening, we're really excited to announce that we're planning to do an in-person symposium this spring in Las Vegas, going to be May 19th through May 20th. The specific details, the continuing education credits and speaker agendas and room blocks and all that, that's still in development. But we do want to let you know, we have been getting questions. We are planning to do an in-person event that's May 19th through the 20th in Las Vegas. Stay tuned. If you read our research report, we will put updates on that when we have registration information. Or if you want to know more, you can always contact us, dwa@dorseyright.com, or via phone 804-320-8511, either about the symposium. If you have questions to get on the list for that, once it becomes available, do so there. Or if you want to talk markets like what David and I were just doing, we're happy to do that with you. We're all nerds for this stuff. So we enjoy it. We sat here for half an hour talking about the market and price movement. So happy to do that with you as well. I'll go ahead and wrap up there. David, this was a good chat. Thanks for doing it this week. Everybody, thanks for your attention, and we wish you the best. Thanks.